Personal Finances PodCat, episode 37. Today we are still going to talk about financial independence. And today we have our guest to be on the show, Mr. Malek. And he is the founder of BFM and also Fi Life at the moment.
Thanks for having me on the show.
Welcome to the show. Thanks. Now, so for the benefit of our audience, could you please briefly introduce yourself?
So I'm Malek. I started BFM about sort of 12 years ago. That was my own second entrepreneur venture. And then now I'm on to my third one, which is Fi Life, which aims to, the word Fi comes from financial independence, which aims to basically resolve your financial anxieties, overall, right, through investments and protection and so on. But I guess I'm an entrepreneur through and through. My first venture failed completely. That was a classifieds newspaper. I ended up with my first venture owing the bank about 300,000 ringgit when I had no assets to my name. And then I was lucky enough to join a great group of young entrepreneurs at the time, jobstreet.com. And I was there for 4 years and became sort of a junior partner in that endeavor, and that worked out quite well. And then my third venture, then it was BFM, and I think I had some of my ex colleagues at ex founders at JobStreet investing in BFM, and then now I'm doing Fi. I'm also getting some ex JobStreet guys as well as my new partners and all that, joining the endeavor for Fi. So it's been a great entrepreneurial journey. It's not often that you can say you have sort of 2 hits in 3, so far.
It's an excellent betting average there.
Yeah, not many people can say that. I'm very fortunate. So this is the 4th one. So whether I can make it 3 out of 4.
Awesome.
Yeah.
I'm just going to throw a curveball here as well, since you're an analogy. If there was one line that you would say to all the entrepreneurs who are watching, what would be that? One single advice that you give?
I think one single advice, resilience, right now, right? I mean, entrepreneurs are all about resilience. So it's and balancing that against the writing on the wall, right? So sometimes you have this. It's 2 sides of the same coin. Sometimes you have to apply your brain and apply your head and logically say, is this going to work? And if it's going to work, then you need the resilience, right? But sometimes, if it's not going to work, you got the wrong model, whatever it is, then you just have to be able to accept that, things are not going to work out. So maybe, take a step back and live to fight another day. So that's what happened to me with my first venture. I lived to fight another day. The other day came almost immediately. I was with JobStreet. And then with radio and with BFM, it was after surviving, not just surviving, but also thriving in JobStreet, and then trying out a third one, right? So I think that's the thing, being able to balance, the right, if objectively whether this business will work. As an entrepreneur, you really know when you when you get that traction, and when you haven't got that traction. When you see suddenly you feel like you talk to customers and they really like your product and they're paying you for it and they're buying it, then you got traction. But if every time you pitch and everyone says no, something's wrong. So I think you sense it. You just don't lie to yourself, lah. So there we go.
Yeah, but just right from your gut. Yeah. So you heard it from Malek. Be smart, be resilient. So yeah, that definitely awesome tips for entrepreneurs here.
What is financial independence?
Yeah. I think the main thing is like when you don't have to depend on your own labor to achieve an income, I think that's, and you achieve a certain amount of income, which allows you not to work. You can work voluntarily, of course, but you don't have to, right? I think that's what you mean. That's what I mean by financial independence. That means that you can do this throughout your retirement. Obviously you don't work, but you have a comfortable retirement as well, and you don't have to depend on anyone else for income, any other individual for income. You don't have to depend on your kids for income. You don't have to depend on siblings, whatever it is. You can just live comfortably, maybe not sort of crazily, you have a normal lifestyle, but still you don't need to kind of like, I need to get a job to get this income. You can live on the passive income that you have, and everything else to be able to have a comfortable lifestyle and a comfortable retirement without depending on anyone. That to me is financial independence, right? So then you will know it, because your worry, your financial anxiety will go away. You're most like, the jobs that you go for are the jobs that you love. You don't have the compulsion to work for someone and so on.
More like passion rather than the dollar sign being chased.
That's right. Exactly. Yeah. So you can choose exactly what you really, really like. So there we are. That's financial independence.
All right, that's definitely a very interesting definition, both for yourself and other people as well. How important do you think financial independence ranks on your list of priorities?
I think it's the highest thing, right? So because it is an enabler, it's an enabler for you to pursue really what you really want to do. So if you have financial independence, it will enable you to do really what you really, we all try to seek a purpose in life. And I think being financially independent allows you to remove one equation, which is how do I survive? How do I feed myself? Right? You remove that equation, and then you can really pursue your purpose in life. For example, I know for a fact, and I'm not allowed to because I'm not a politician, etc. One of my purpose in life is to reform the Malaysian education system. Right? We have 10,000 schools. We spend a lot of money on as a percentage of GDP on those schools, but we're not getting the results. We're not getting the results that we ought to get with that amount of resources put into it. And I think, so that's my purpose in life. And right now, there's no opportunity to address it directly. So I can address it indirectly through a radio station that educates, right? I can address it also through financial education, like what we're doing now. We're addressing one segment, which is to make sure that at least the adults in the room are financially literate, are financially well. But to me, if I were to ask a purpose, I like to target those 10,000 schools and figure out how to get them to the next level. And I think that to me is the if you want to see Malaysia progress economically, socially, we need to address that. And I don't think any politician. I know we started a few things. We have something called Malaysian National Education Blueprint, but politicians, they're busy thinking of their own interests right now rather than interests of Malaysians as a whole. So I think that's where I think us in the private sector need to come in, and that's my purpose. So coming back. What allows me now right now is if I wanted to go into that right now, I can, because I am financially independent. I can, but it's just a question of waiting and choosing the right entry mode, etc. So in that sense, I can pursue this, higher level, they call this Maslow hierarchy of needs, right?
Right.
Yeah, I can pursue those higher level things without worrying too much about whether I can put food on the table the next day.
I really like how you're tying in, Maslow's and self-actualization with financial independence, actually. And I totally agree that, education is right at the core of a lot of things that, would matter for a country, its economy, etc., as you mentioned. A little bit off tangent, but, on education itself, how important would it be, if you're, really looking to reshape education in Malaysia? How important would financial education be as part of this education reforms?
I think it will. I think fundamentally, it can be part of it for sure. But I think the most important thing is the power of analysis, the power of critical thinking, the power of argument, the power of debate, the power of being a sponge to absorb knowledge and critique and finding, not just accepting everything blindly, right? So I think that fundamental critical thinking stuff, if we sort it out, you would, if we actually are able to impart that, I think financial education will come naturally, right? So when someone comes to you with a scam, you're using your critical thinking and going, hey, what is this about? Why is this? Why are they promising so much returns? That kind of thing, right? So basically, to me, critical thinking is the core. And then I guess financial education, geography, math, English can all come on top of that. The most important thing is the ability to think critically, to analyze data, to create arguments, to figure out what the problem is, that kind of thing, and solving problems. I think those are the real core of education. And then after that, you can layer on anything, like any subject and all that. You can do that, and I think that's not an issue. The core is still critical thinking.
Yeah, thanks for sharing that, and I really think you're hitting the nail right on the head with that.
I know there are a lot of strong believers who are about FIRE movement, which is financially independence and retire early. And what do you think of that?
Well, I mean, from what I've read, it's not it can be quite a miserable lifestyle. when you're saving 50%, 70% of your income, I think it can be, and then you have a target date, and then after that, you kind of like when you have a target date, okay, I'm going to retire at 40, right, or 35, whatever it is, and then I'm going to use whatever I have then, and adjust my lifestyle so I can really live the rest of my life and do what I want to do. I'm not sure. I disagree. I disagree simply because, for one, that date is artificial, right? Why do you have a date to retire early? There is just like it's almost like, oh, you're cutting your phases of your life, and you're cutting your phases of your life to like, oh, until I'm 21, I'm being educated. I learn, absorb as much as possible, and then from 21 to 40, I work as hard as possible and I save as much as possible. And after 40, 45, then I retire. Then I can do what I want. I seek my self-actualization after I'm 40, after I've done my FIRE stuff, right? I think that's the old way of thinking, doing things. That is really, that's not the way. I think the new way of doing things is that, your education, it continues. It continues. I mean, I'm doing a LinkedIn course, for crying out loud. I'm 53 years old, right? I'm doing a LinkedIn course. This morning, I spent 4 hours sitting down with, a bunch of millennials, right? Learning how to use LinkedIn effectively, right? So I'm continuously learning, right? But does that stop me from continuously also working a little bit here and there? I'm working too, but I'm also enjoying as I'm working or as I'm in between, right? So I'm doing all these three things at the same time. In a sense, I'm a little bit retired because I'm sort of, I have what is retirement in the end? The ability to you dictate your time. So I'm dictating my time, what I want to do. So this, I think FIRE is an old viewpoint. I think this was something in the 90s. It started from a book from the 90s, if I read my stuff correctly. But it's actually when you discreetly have your, study, work, retire. Nah, to me, it's strips of a bit of each all throughout. I'll give you an example. I had a break. I had a fantastic break. Even before I started university, I had a gap year. And then I went to India for 3 months on the hippie trail, right? Let's not go into what I did during the hippie trail. But I went to India for 3 months, traveling around, sleeping and sleeping on boats and things like that. And I had that before university. And during university, I took a summer off and went to America and worked there as well, and work as a hotel receptionist. But that to me wasn't work. It was enjoying life as it is. And then guess what happened? I did 2 years. I started working, and then I did 2 years MBA. The 2 years MBA was a bit of a break as well. Another break for 2 years, and I was only like 27 years old at the time. I already had a 2-year break during my MBA in a fantastic town called Boston. Right, it's wonderful. And then, I joined Boston Consulting Group. And then I took 6 months sabbatical to figure out my next move, right? So I have a lot of breaks in between. As I think I'm not jumping from one job to the other. I'm actually taking breaks in between, experiencing a little bit of retirement feeling, right? I have nothing to do today, or I have nothing to do the next 3 months. What do I do, right?
So I think that's a brilliant idea, pre-testing retirement, rather than jumping, head in. Yeah.
And then so I'm doing that throughout my life. I'm learning throughout my life. I'm working throughout my life. so you just kind of like basically just kind of like be able to like plan a little bit. So this idea about work hard, save hard, bang, 45, now I'm done, I retire, and look for self-actualization around that time. Okay, you can look for self-actualization anytime.
I think it's not just that like we look at financial independence differently. We also look at retirement very differently now.
Yeah,
that's
Shouldn't
right.
be like the back days where people just stop working.
Yeah, it's not that. Yeah, I mean, to me, fantastic form of retirement is being able to spend, for example, when I'm needed, being able to spend really on the ground in schools in Malaysia. And I would say like for 9 months, when the school's not on holidays, I'm literally going to every school, right? Working out the stuff. Then when it's school holidays, I'll take an Airbnb and go to, I don't know, Machu Picchu, right? I'll go to somewhere and just go there and just spend somewhere for 2 months. But during those holiday period, spend 2 months somewhere and just live like a Peruvian, right? For 2 months. Right? So that to me, in fact, to me, a fantastic retirement thing is to actually to move from place to place every 2 months and experience a country or a region and use it as a base, and then Airbnb it, and just live and experience the experience the atmosphere, the people, and then after that, and say, okay, now come back to Malaysia for a while, ding dong, and then back again, next country, right? I think that's my I guess my not retirement plan. I guess that's my part of my retirement plan is to be able to travel and work at the same time. And now, of course, you can still work at the same time, right? You have Zoom and you have and so on. You can just continue to work. So I think that's that's part of the plan.
You can even do that like right now if you want to.
I think my problem is I started another new business, right? So I have to, and so I'm like, okay, why are you doing this? Well, because that's that entrepreneurial thing. But I think if I wanted to, I could have just kind of just okay, take the accelerator off the pedal, and then just do this. Right? But I think right now it's okay because I guess I still have young kids, and I can't, and they, I'm waiting for them to go to college and university and so on, right? And then I'm like, okay, now I'm free. I don't have to be a parent to you on a daily basis. I can go off, right? So I think I'm just waiting for them, and that's still quite some ways away. I think that's still about 8 years away. My wife and I were calculating.
That definitely sounds like a fantastic thing, and quite aligned to what I would desire to be doing as well. And I think it's such an inspiration. Age 50, you're starting up a new entrepreneurial business. You pursued your certificate in financial planning. You want to share some thoughts on that? What's driving you to pursue all this?
I guess I want to be able to legally advise people. Right now, I have to I have to pass them to people like you, Steve, which is fine. I wouldn't mind doing that. But there are some folks that I would like to be able to at least give individual advice to. So I think that's one thing that I want to do. I do it informally in the sense of this is what I'm doing, but you want to do it formally, right? So. I just had a CEO of a thing texting me this week saying, Malek, you're talking about this before. Can we have a phone call about this? Right? Can we talk about this? And right now, I need to be able to get the qualifications. And CFP is just the first of many that I have to do to be able to give that financial advice, right? So, yeah, I love to be able to be in a position to have a conversation with my peers, and they are my peers about how to be financially independent. CEOs also have a problem trying to be financially independent.
At all levels, yeah, definitely.
I guess you are probably one of the best person to answer this question now that you're on the show. So could you share with us 3 actionable steps to achieve financial independence?
Okay, and here I'm going to ask Steve to help me out a little bit with 3 slides for this three steps. Right. So step 1, cash flow positive. Right. I think. Steve, you're a licensed financial planner. You need to do your cash flow statement, etc. But fundamentally, if you're not earning enough, or your income sources are not enough to pay for all your expenses, then it's hard to kind of build from that, right? You need a little bit of an extra thing to go to step 2 to step 3. So this is step 1. get yourself to cash flow positive phase, either by working, increasing your income, or in a way managing your expenses. So it's like any company. I mean, I'm an entrepreneur, right? It's always about. I talked to you about just now about COVID. How we need to be cash flow positive. Likewise, with individuals, we do the same thing as well. You need to be cash flow positive, income coming in, and this is disposable, and this is sort of your net income after taxes and all that coming in, is more than what you pay out in expenses, right? Or in mortgages and all your debt, your interest payments, etc. Once you get that cash flow positive, then you're like, okay, then I can save, right? I know some people say, yeah, save first and all that kind of, but I'm just saying, just as a fundamental level, income coming in must be more than expenses going out. That's tip number one. And I think this applies not just to, it sounds very basic, but it's interesting. As you get, and this is my experience of, my peers, as you get more senior and you earn a higher salary or a higher income, your lifestyle catches up with you somehow.
Lifestyle creep, yeah.
Lifestyle creep is that bigger house. It's that is that bigger car. It's that sort of there's schooling here. There's this school which is 1,000 ringgit a month, but this is really great school at 3,000 ringgit a month, right? So you go for the really great school at 3,000 ringgit a month, right, for your kid. So your lifestyle does catch up, and I think that's one thing I learned at Job Street. And my first venture, my Job Street, I think I worked for the founder of Job Street is Mark Chang, and Mark is the most parsimonious person I know. I swear to God, he's the most. Every single dollar of cost. I came in as a BCG before Mark. I was like, I had my classifieds, my classifieds business, and I was a BCG consultant. BCG consultant earned, I don't know, at the time, maybe even like 18,000 ringgit a month, okay, in the 90s, right? And so my lifestyle was according to that 18,000 ringgit a month. But then I went to Job Street, and my gosh, my my income, my first salary, I remember Job Street was about 6,000 ringgit a month, which is still quite generous for a startup at the time, right? So. And every dollar that we spent, Mark was very, even I wanted a laptop. Mark questioned me on laptop. Malik, do you really need a laptop? Could you use a desktop? Right? Okay, I need some money for marketing. Malik, can you generate income from, sort of your email database and use that for marketing? So every single point of thing. And I think it is a little extreme, I think, in the spectrum of things. But because Mark was so extreme, I was brought from the other, not the other extreme, but the other side of the spectrum, and I was brought a little bit to the center, right? Meaning, I think now I'm at a place where I will pay more for something if it's not so much price but value, right? So, coming back to the main point, your lifestyle does catch up with you, so you just got to be conscious of it, and I think what I've learned from my experience in startups is that life is never. You're always worried about. You're always worried about what might, the things that might happen, crises that might happen. I've been through the 1997 Asian financial crisis. I've been through the year 2000 dot-com crisis. And in a way, I guess, I've prepared myself for crisis. And this COVID is one of those crises that I've prepared for personally, right? So I guess in that sense, I didn't allow my lifestyle to go to catch up with me. So that right now you're still able to become cash flow positive during this time. So BFM is cash flow positive now. Why? Because we had reserves. And actually even we went cash flow negative for 2 months, but we can survive that because we had reserves. And why we had reserves? Because of my experiences in the Asian financial crisis, my experience of the dot-com crisis, my experience of the 2008 great financial crisis. So because of that, we had reserves. We didn't take out the money, dividend it all out. We kept the money in the company and so on. So I think likewise with us, with individuals, is the same thing. Cash flow positive, and you need that. The financial planning thing. You need your reserves, right? People say 6 months. Maybe you need a year. Crisis like this, you need a year. But 6 months is a great start. But you need that 6 months. So cash flow positive, and this once you get cash flow positive, that's when you can actually sort of start to think about, all right, now I'm cash flow positive. What do I do with it? What do I do with the excess? And then we come to, step number 2. Right? Step number 2, protect. And that's the business I'm in. I'm in the business of protection. If you have I'll tell a really tough story. My brother, half brother, we didn't interact very much when I was very young because we had different families, but got to know him better when I was older. He had his life planned out for him. He was a tin trader, metals trader, and he worked really, really hard all his life. And I think he was approaching his 60s, and he said, I'm going to retire. And he actually fantastic. It's like fire. He had a target date at sort of 58, 59 years old. And then he said, this is my pot of sum, and he was going to travel for a year. He reserved it for traveling for a year. And then he will have enough for his family the rest of his life. But no protection. He didn't buy anything for himself, didn't buy anything for anyone. And then one calamity happened. My nephew was involved in a car accident and lost the use of his lower half of his body. Right, he's in a wheelchair right now. Great kid. He's almost 30 now. But because there was no protection, that dream of my brother, he didn't think twice about it. Nope, yeah, stop that. That was a dream. I'm now going to switch all those funds to kind of care for my son, right? But so to me, the step 2 is really important. You need to protect because calamities happen, and it's a small price. It's a really small price when you pay a small premium, small relatively speaking, to just to make sure if something happens to you or your family members, that you have a financial backup plan. There is a financial not compensation, but a buffer for you, right? So in this scenario, supposing if my nephew had been insured, my brother would not need to have touched his life savings to do something and he might decide not to travel, but at least he had the option to if he wanted to, right? So to me, protection is important. You protect first. You worry about investments later. You protect first. Make sure that you're insured against, if you have kids, make sure that you are insured so that if something happens to you, your spouse or anyone who's the guardian of the kids has a sum that they can use for your kids' education until they reach adulthood. That's key. If something happens to me, the worst thing that can happen to me is not dying. Actually, the worst thing that can happen to me, I'm completely disabled. Right, I'm a vegetable. That's a double whammy, right? You lose an income, you lose my income. If I'm a working person, you lose my income, and not only that, you have to take care of me as well. It's a double whammy. You have to take care of me as well. So you got to make sure that you have disability insurance, which usually comes with life insurance, right? So total and permanent disability, that's really important. In fact, a lot of people say, I would say that because of the double whammy, you got to make sure that that's the highest amount, right? So I think that protection, step 2 is important. Make sure that your bases are covered, that make sure that things. And yes, I mean, we can argue, what is the right kind of insurance. I don't think there's the right forum for that, but you can argue what kind of right, but the insurance actually you can get some really, really good value insurance out there. And my only point is, if you just buy it for protection only. If you start buying investment-linked stuff, then you're mixing 2 things. And I prefer it to be step 1, step 2, step 3. The step 3 is investing. I don't like to mix my protection and investing. Step 2 is pure protection. Make sure that you get the best bang for the buck. Pay the premium to get you 1 million ringgit protection, 3 million ringgit protection. It's not that expensive. Right? I think I did.
So earlier for emergency savings, you shared a band of 6 months and 12 months in the crisis situations that we see right now. How about for protection? Different people have different opinions. Let's say for total permanent disability, how much coverage do you think someone should have?
I think it depends on your needs, right? Your needs. What if your kids are young? My gosh, if you have kids and they're young, that is when you are at the greatest need. So, for example, if my child was 1 year old, and my protection would be higher than if my child were 21 years old, right? Why? Because I have to support that child. I have to support my daughter from the age of 1 to 21. If something happens to me. So that means her education, her living expenses, she's going to university and all that. But once she's an adult, my protection, the amount that I need comes down because I don't need it. Right now, it's like, okay, I only need it maybe for my spouse. So how much it is, and we both have done the financial planning thing. It really depends on the needs of the individual, of the family. And to me, I have a sum right now, for example, that is in 7 figures, because my needs are, I have a 13-year-old son, all the way to an 18-year-old daughter. I have 3 kids, and therefore the needs are still quite high. But once they go to university, once they become adults, the needs come lower. I don't have to support them anymore. Then you just need to support, either the youngest one or your spouse, which is not working. So it really depends on you. It depends on whether your spouse is working or not. If your spouse is not working, you need more, right? If your spouse is working and is kind of like, can provide for the family without you around, then all you need to figure out is just, okay, she doesn't need really anything from me, and she can take care of the kids, but maybe I need something for her to take care of me if something happens to me and I don't die, I'm a vegetable. Then you need, like, how much does it take care of me if I'm a vegetable at home? How much does it cost to take care of Michael Schumacher right now, right? It is a lot, right? Michael Schumacher is costing the family a lot of money, right? But so how much is it, right? So I'm sure they're okay. But I think that's the is really based on needs and not necessarily a magic number.
Thanks for sharing, especially in the quantum. And yes, it does vary. How about from the perspective of duration itself? Let's say term coverage. When should someone be looking at shorter coverage, 5, 10 years, or should someone be looking at something that's whole life?
Yeah, I guess it depends on the on your dependents. How long do your dependents depend on your income, right? So for me, if it's a 1-year-old, if I have a 1-year-old child, I'll get a 25-year term policy, right? Because I want to make sure. So the university, usually people graduate when they're 23, 24 now. So 25-year policy covers it nicely. I've actually sort of reduced my policies already because I don't that critical phase of when they're really young is over. So now and my assets have increased, so I can sort of I can take some hits a little bit, so I don't need such a high amount. But basically, it depends on how long your dependents need it. If, for example, if I'm at the stage now where all my kids have graduated and they're all independent, then I just have to worry about my non-working spouse. And I say to her, okay, here's some assets, but how much do you need on top of that? If I'm a vegetable or whatever it is, right? Or maybe we need another 10 years, or maybe another 15 years till you're till you're 70 years old, and then you have the rest, kind of thing. So I think that also is a function of what stage of where your dependents are, how long they depend on your income.
Definitely. And yeah, I think talking with your spouse, your loved ones about matters of money are really so important. And here's your third point, I believe.
Yeah. So the third point is, after you've protected yourself, then the question is, okay, how do you build out that not just that nest egg? How do you build out the education funds for your children? How do you build out that retirement fund for yourself so that you can be financially independent, right? So you've covered, you're cash flow positive. You covered all the calamity situations. You got health insurance, you got personal accident insurance, you got life insurance, all that, and that doesn't have to be expensive. And then the rest of it, you invest, right? And this is the thing. I see a lot of people mixing, as I said before, insurance and investment. I think that's really. I disagree. And I think this is where you need to have the greatest flexibility in investing in anything that you want, and that flexibility comes with separating protection or insurance with investment. So now you've covered your protection, and we're talking about ringgit for a 30-year-old woman, a ringgit policy for a 30-year-old woman, even with Fi Life, costs less than 100 ringgit a month, right? 100 ringgit a month gives you a 1 million ringgit policy for a 30-year-old woman. So the rest of it, you can use, say you're saving 1,000, the 900 of it you can invest, right? So I think that's step 3, is to invest. And I think when you invest and you have, and as always, compounding, the rule of compounding, invest when you start early. When you start early, the compounding effects will be much, much greater. So this element you can take and invest and create that nest egg either for your children, so that they can go to, you have enough when they're ready to go to university, etc. Or for yourself, right? So I think that's what happens. It means you're saving for your retirement. And if you're 30 years old, you got a 35, 40-year horizon, right? No, not a problem. And so I think this is step 3. If you don't invest, and I wouldn't say putting your money in a fixed deposit is investment. That's not investment, right? Investment is actually going for something that generates returns. That it's not a fixed deposit return. It's more than that. It's something that generates a return higher than inflation and can build out that nest egg for you. And that's step 3. And then we can talk a little bit later about how to. But this is the 3 fundamental steps of financial independence. Coming back, it's cash flow positive. First, make sure you're cash flow positive by either working the income or working the expenses. Number 2, protecting, so making sure that calamities that impact calamities, you have money to deal with calamities. The last one is then with a balance, and you will have a lot of balance because you're not mixing it up with investment-linked policies. Investment-linked policies, you invest it, and you have a complete whole investment world, the whole investment universe to invest in. You're not limited to certain insurance company funds, certain unit trusts. You're not limited to that. You have the whole investment world, all the way from equities to mutual funds to unit trusts to exchange traded funds to robo advisors. That whole spectrum is open to you and is completely flexible. I think that's the most important thing.
I really think these 3 points are really, really useful. Especially one thing is the sequence of it, and also another is how clear-cut these 3 different points are. Because I really know that there are a lot, like especially the younger ones, that they kind of mix up between these 3. There are a lot of them would actually come to us and say, I want to start investing now.
Yeah.
But what about the first step that you actually forgot? Like, yes, investing is definitely good. But have you actually sat down and really look into your cash flow statement properly? Because there's no point if you have one lump sum and just invest. We all know the power of compounding. If you have just one lump sum and just keep investing, and compare to if you can do it regularly and consistently, it will be way more powerful. So it's really back to the point where before you want to talk about investing, or before you even have the capability to protect your assets, sit down and look at your monthly cash flow, which is your money in and out.
Yeah.
Which is a very good point.
There's a way to do it. There's a way to do it where I think in companies, where if we work for companies, you get bonuses, right? So there's a way to kind of say, I'm maybe you say, I'm just tiny bit cash flow positive. I don't feel I have enough. But then when the bonus comes in, don't buy that car. Don't buy that new car, right? Just park it into an investment, right? So then you can choose and don't put your 20,000 ringgit that you get as a bonus completely into one shot pump. You put that, you just drip it, right? You drip 5,000 in case the stock market goes up, stock market goes down. You get your dollar cost average, the thing, right? So, but don't use it to now I'm going to put a down payment on a new car. I
think we also wrote an article about how you can use your money if you can suddenly get a bonus.
Yeah. So I have a fault. If I get a bonus, I'm itchy to spending on. I'm itchy to invest it on equities. That's my problem. Sometimes I'm like, when I get bonus, I'm like, okay, what can I invest it in? So sometimes I'm like, hey, maybe slow down. University fees are coming up.
Well, I mean, if your emergency savings and your protection is there, that's a good problem to have there.
Yeah. And also it's back to your risk appetite, which clearly shows on the aggressive side. what is your investment breakdown by percentage between your different asset classes?
Okay, so Steve asked me to prepare this like beforehand. I didn't come this number off the top of my head, so I had to this afternoon I had to like really like kind of like work it out and so on, right? So right now, even taking into consideration what you said about sort of 6 months cash, etc. It's about right now is cash is only about 3% of my portfolio. The vast majority of it is not vast majority. The majority of it is in equities right now. 52%. The green one is in equities. To me, I've been shown a chart where you look at the Standard & Poor's performance for the last 100 years. And if you to pick any two time periods, right, where you started and end, it has never, as long as you cover a period of 12 years, you will never get a negative number. If you put 12 years, you will never get a negative number. Basically, if you take any 12-year period and following the S&P, and you kind of like, even if you put one during the depression and then you bought just before depression, 12 years later, it does come back, right? So to me, equities as a long run thing, if you have a 12-year, at least a 12-year horizon, if you're talking about international markets, not necessarily the Malaysian market, right? Diversified market, I think you will have that sort of, you will not be in danger of losing that capital. Right? And I think that is the equities market for you, because it is, countries are growing, companies are growing, they're having income and so on. And if you have a diversified portfolio, I think that's why I involve myself. I mean, equities is the thing. I have at least a 12-year horizon, and that's almost more than half of my portfolio. The others, so I have property. Property is about 23%, meaning actually that's not REITs or anything like that. And maybe I should convert it to REITs, but right now it's basically the second investment property, right? That is valued at a certain amount. So and when I look at it, and this property is in Singapore because I live in Singapore. It's in Singapore properties are very, very expensive. So so I managed to get myself on that. So that forms about 23%. I would say things like EPF, EPF and I have also CPF in Singapore. I would say they generally invest in bonds. So I don't invest personally. I don't own my own money in bonds, because I think there's already your CPF and EPF already pretty much cover that bond segment for you, right? So you kind of like
the majority in bonds. So
yeah. Okay. So why do I I don't need to. I count it as part of my portfolio, right? In the sense of like, okay, that's a bond portfolio. But I have the difference, I guess, with a lot of people, with a number of people, is that I have about 14% in my own endeavors, my own businesses. So and this is at book value, meaning it's how much I put it in it. I'm not thinking of actual value. Actual value will be more than that for sure, but it is speculative. How much is BFM worth? I don't know. I can come up with a number, but it's willing buyer, willing seller, and I'm not selling anyway. So it's an academic point. But in terms of book value, how much I have invested in business and so on, that's about 40%. So I think this is my allocation, and I know what's missing here is what I call exotics. Exotics are Bitcoin. Exotics are even precious metals to me are exotics.
Yeah, we would group them together. Yeah, alternate assets.
Yeah. Alternate assets, and to me, I'm of the Warren Buffett mindset. I want to buy something with income. I don't like buying something just for the sake of storing value. And much as I Robin Lee of Hello Gold is a good friend of mine, and we promote his thing because it does, for some people is a good thing. They like it, and they've been. You bought 3 months ago, you're laughing all the way to the bank, right? But for me, it's not. I need an income. My personal frame of mind is to buy something with income, and so the property buys income, the bonds buy income, obviously, the equities buy income, and definitely my businesses bring income in. So I think that's my asset allocation. And I'm at 53 years old. If you look at this, it's quite aggressive. It's very aggressive, right? Because you're talking about equities being 52%. Generally, people say when you're at my age, and supposedly 3 years, 3 years away from retirement, you should be, start loading up on bonds a little bit more income producing equities. Income producing, dividend based equities and bonds. So, but for me, I'm still, I think, touch wood, there's at least another 25 years of my life. So, that covers the equity period of 12 years. No problem. I'll definitely have this money in, I don't need this money until 12 years time. So there we are.
All right. Definitely.
Yeah. And within equities, there's also, you can see the aggressiveness coming in as well. And if you can turn to my equity allocation by geography, is, if you look at it, Malaysia only forms 0.3%. So to me, it's US equity is about 73% right now. I'm moving some towards China and Hong Kong exchange and taking about sort of 25%. But directionally, I'm moving from the US to China and Hong Kong tech to balance it out a little bit. I would like to see it something like, 60 US or 50, almost 50-50, 50 US and 50 China, since they're dividing anyway. They are taking their own ecosystems. And so I want to follow those ecosystems, right? So, I don't think, I'll just follow and just have a stake in both. So even if they fight, it's okay. I'm a, if one wins,
we should have a party, yeah.
You're like, okay, you just bet on both. You just bet on both, so that's, but the interesting thing is Malaysia. Why Malaysia is so small? It's because, what is it? I used to be big. I used to invest in Malaysia a lot. I used to invest in petroleum services companies, and I invested in Digi, for example, so on, and had a great run, fantastic run. But a couple of things that I think, I guess as time went on, I wanted a more diversified portfolio that's not based on one country, and one country where the currency has actually, if you look at chart of ringgit against whatever currency, it's been depreciating, right? Only until recently, but it's been, the long-term trend is depreciation, and there's nothing that comes out of our government's mouth that says that they want to, there is a bit of like we want to maintain ringgit at this level. There's nothing that comes out of our politicians' mouth. Everything I say, we must make our exports more competitive. We must make our exports more competitive, and therefore, what that means is, and there always is, the currency is a lever to make exports more competitive. Right? So I don't have that confidence that the ringgit will hold, and that's why my expenditure is in Singapore dollars. I live in Singapore, so I cannot have a ringgit asset base that is depreciating, trying to support the Singapore lifestyle. So that's why it's overseas. It's abroad, and that's why that's why my allocation is. So why US? Why China? I think the big two superpowers. Just go for both of them. Singapore, some not that much either. So more on the companies I'm familiar with. And then the equity allocation. Now this is also a super aggressive type portfolio. If we look at my equity allocation by sector, which is the next thing. If you see it, it's basically US tech is 41%, China tech is 24%, and financial services is about 29%. Financial services is the one in yellow, and other things like F&B and food. I think that's like Yum China. That's that's Kentucky Fried Chicken in Thailand, and and so on. And that's so that forms the F&B, which is the green part, and others a hodgepodge of healthcare, this and that, property even. That's about 4%. But if you can tell, tech is my thing, whether it's Chinese or American, and to me it's companies like it's companies like Amazon, it's companies like Facebook. Oddly enough, even though I really wanted to invest in Apple, I never got the chance to do it, and then the prices ran away and never caught up. Right. Oddly, also, I believed in Reed Hastings when his stock price just crashed 30% when he announced that he was just going to stop the DVD business and charge for streaming. I believed in him, but you're so busy with BFM, so busy with work, you never put that 10,000 or whatever it is into that, right? So those things. But I managed to do it with Amazon, I managed to do it with Facebook, managed to do it with Google. So that's my US tech.
I
China
think Buffett says it like, most of the mistakes he regrets are those that he missed by omission, twiddling his thumbs and not doing anything about it. Yeah. Mostly your holdings, all direct stock holdings. Do you go for ETFs, especially like in China, etc.?
Yeah, so I had a fund that goes for China, but actually the fund has been okay. It's been all right, but not as good as my direct investments. I'm performing better than the funds I invest in. So I pulled it out. The China tech stuff that I have are the obvious ones, right? So it's Tencent, it's Alibaba. So those are China tech. Sometimes with China, I need to trust the management more. And I think there was, for example, one of the big guys. He got caught with a kind of like sexual assault case in the US, and so on and so. And when I speak to my Chinese counterparts, they're not sure of that company as a whole. So I don't invest, even though they're a big name. I won't mention it, but they're a big name. I just don't invest in it. I just invest in management that I think I trust. And you guys heard of Luckin Coffee, right? That's a management that really screwed their shareholders. And you don't want to. So you really want to go for the safe stuff. I mean, the good management teams in thing, and you only get that by talking to people who are their suppliers, who know of them and so on. So to me, it's right now it's Alibaba, Tencent. It's also Ping An Insurance, which also has something called Lufax as I think so. All this that's my China tech, and I'm keeping an eye on it. I just recently bought SMIC, which is a Chinese semiconductor company. So I'm building up this position bit by bit in China, so that this should look more like 30-30 after a while.
As the average investor, do you think there's enough information on markets, especially in countries like China?
I think there is, yes. There is enough information. I've used Yahoo Finance as kind of like my news gathering. They have a finance news aggregator feed, and yes, they're much more. They're better for the US stocks because you get daily updates, whereas Chinese stocks, they tend to be a little bit more sporadic. But in terms of just reading material, even if you listen to BFM, I bought SMIC because I heard a guy on BFM, an Australian analyst, Jack who came in on Tuesday, I think, and he mentioned SMIC. And I'm like, that's interesting. Let me look it up. And I looked it up, researched it, and so on, and thought, all right, I'm willing to buy in this one, right? I've never heard of them before until I heard it on BFM. So it's great. BFM to me is our commentators are giving me ideas and so on, right? So this is great. So I use BFM as especially the international analysts, just to kind of like give me a bit of a flavor about what's going on. And sometimes they mention certain counters which I can invest in. So so I think that's enough information for investors out there. It's just a question of whether you want to check out the news aggregator sites every now and then. I generally track. Before I buy something, I generally track them for about at least 2-3 months, just to see, make sure that they at least let's see how they go to their first earnings. That since I have tracked them, how do they respond to the earnings type thing, right? And then just listen to the earnings remarks and so on. So a bit of that tracking doesn't take a long time. I mean, it's just basically 20 minutes, looking through my phone in the evening. And then 20 minutes in the morning, right? So that's just a little bit of reading up here and there, and you can make decisions there. There's some I must say there's some being in my line, you can actually also get information that other people don't know about. I'll give you an example. The reason why I bought Amazon was not because of e-commerce. I bought Amazon because of AWS, the cloud service. Why? Because at the time, Amazon didn't break out their e-commerce, their revenues, right? AWS was put in with everything else. So no analyst in the US knew what AWS amount was, right? How big a business it is. But me, little puny company in Malaysia, we were buying AWS, right? I'm like, we were on the other side of the world, and we were buying AWS, this cloud service. And guess what? Astro I know Astro, and someone put a number whispered a number in my ear. They were spending $1 million, $1 million, I don't know, a year or a month, I don't know what it is, right? But they're spending 6-7 figures on AWS. BFM was spending maybe about 6,000 ringgit a month on AWS. Astro may be spending about, I don't know what, right? So I'm like, wow, we are companies at the other side of the world buying this service of Amazon that no analyst in US is talking about, right? They're all talking about e-commerce. And they're talking, Amazon margin is negative or minus 2% for e-commerce. I'm like, actually, their margin on AWS must be huge, right? So yeah, Amazon at the time I remember at a town hall at BFM, I said, look, we just gave bonuses. I remember going to guys said, look, if you guys seek your own financial advice, but I tell you what I'm doing. Amazon, I put a list of all the stocks out, and I said, okay, Amazon, this. I'm going to buy Amazon at $238 US dollars, right? I said, I'm going to do this. You can join me if you want. I mean, if you are thinking this is what I'm doing, you can follow if you want, right? So that was $238 US dollars now, and now it's 3,000. I don't know, 3,002, 3,000, 3,003, right? So that's and that's because I knew something that the analysts didn't, being on the other side of the world. Same thing happened with some other industries I'm involved with. When I was with Yahoo, I was working for Yahoo for a while. I knew that Google were just basically, whipping our asses, right, at Yahoo, right? So the moment I left Yahoo, I sold my Yahoo stock and bought Google, right, because they were whipping our asses. I was working for Maxis, and I knew Maxis did not fear Cellcom, did not fear Cellcom. We feared that Maxis, the team at Digi were just like, every time we did something, team at Digi was just like coming back with something else. And it was so frustrating for Maxis, right? Basically, any campaign we put out, Digi would come back with something else. I'm like, oh my gosh, they're a really good competitor. The moment I left Maxis, I sold my Maxis shares, I bought Digi. And that was a 10xer, right? Those are 10xer. So that's the kind of, sometimes when you're working in a certain industry, Another example, I'm at BFM, and here we are selling sort of radio advertising and all that, and everyone comes back and says, oh, what about, and then we know that people actually, advertising agencies are moving towards digital buying, right? So what do they buy? They buy Facebook, they buy Google. Again, so when Facebook listed, no brainer, just go for it, right? Because we on the other side of the world are buying Facebook. So, in a way, there's sometimes when you're a little bit ahead of analysts in the US, simply because of where we are. So I take advantage of that, right? So
taking a step back as well towards the asset allocation.
Yeah.
You talked a little bit on alternates and exotics, but other than that, is your asset allocation the ideal asset allocation that you had in mind, or if you had a magic wand, what would you change about it?
I think to me it's okay, it's fine. If anything, maybe what I did was I have cash for living expenses, but when the downturn came, when the COVID-19 came, I realized I was fully invested, and I didn't have cash to take advantage of the COVID situation. Meaning the stock market price went down, fantastic stocks like MasterCard went down 40% in value, and there were so many coveted stocks that I wanted, because I'll be honest, in this situation, I bought it at in my mind, I already anchored certain buy points, right? And when those buy points were reached, I started buying, but it was actually too early, right? So I had used up all my cash for investments too early. That means, it wasn't still 18th March, it was still mid-March, right? And it was still going down some more, right? So, and that's when I thought that at the time, I should have at least had a little bit more of a cash thing, not for sort of living expenses, but just allocating cash more so that you can buy into in the future a lot more. Right? So I think there was a time when I think in January where the prices were record levels. Maybe I should have just taken some off the table, take 10% off the table, and put it in cash to reinvest again. I did a crazy thing though, and I'm not afraid of it, and that's how super aggressive I am. Because I didn't have cash, what I did was I said, look, these companies are really good value. So, and interest rates were going down. So I took out, I remortgaged my property, one of my properties, to get some cash, and I piled that cash into that downturn we had in March, April. So that means I'm in that sense I'm willing to make a calculated risk to say like these are good value companies. I've always wanted to buy them, and no, my gosh, they're 40% of their prices. By the time I organize the home equity loans, they're about 30% of their prices, but still good, right? So I just went in at that point, and now I've increased my I've increased my debt level, but you know what, the interest rate is only 1.5% per annum, but my gains on that amount is already about 25%, right? So it'll pay off 2 years worth of sorry, it'll pay off like sort of 15 years worth of interest already, right? So I would not recommend that to anyone. I think you only do that if you're a bit more of a sophisticated investor, and the downsides. And if worst comes to the worst, if things go belly up, and the stock market crashes, can you survive that? And my calculation was, yes, I can survive that, right? I can pay off the loans and so on over time and so on. Not an issue. I might have to liquidate this. Might have to liquidate my second property or something like that. But I can do all that, right? So, but it's not something to be done for the sort of people who do not have cash, but someone who and sometimes I feel that this is where the world is a little bit unfair. It's because when people have access to financial capital already, you have assets for which you can get more financial capital in form of debt to reinvest. And I think that's sometimes sort of doesn't work for someone who doesn't have that credit worthiness or doesn't have that asset to be able to back it up. Right? So
that's always that saying, that your banks will, lend money to people who don't really need it because, you already have all those assets. Yeah. And definitely for everyone tuning in, just as a general disclaimer, as always, do not take any of this as investment advice. It's not investment advice. We're just having a chat on financial independence and money-related matters.
Yeah, I think I just use that example as to illustrate my risk profile, and it's extreme. My risk profile is very, very extreme. But I'm still not, and to me, extreme in terms of like equities and so on. But I still buy solid stocks, good stocks. There's a lot of research that goes behind it. But I'm willing to take, liability risk to be able to execute that. I'm still not super aggressive to be able to invest in, the exotics, right? The alternate investments. I don't buy Bitcoin. I don't buy metals. But on the other hand, I do invest in businesses, and that's a super, super, super risk if you invest in a business, right? So there we are. Our personal preferences, I guess.
Very interesting sharing on your asset allocation and investment. So we are in the month of August now. So tying into our Merdeka month, what are your hopes and aspirations for Malaysia, especially for a finance or economy perspective?
Yeah. So I think my hopes is that Malaysians, however you are, I hope with COVID-19, I hope you are able to survive and stay afloat during this time. If you have a job and you're continuing, fantastic. But if you don't, I hope you have the resources and the resilience to survive this period. I think that's my hope for Malaysians during Merdeka. It's not an easy time. So here I am talking about taking advantage of stock market crashes and so on, and other people are worrying about the rice bowls, right? About putting food on the table. So I think one needs to kind of like be cognizant that there are people who this is not even an option. Right? So for me, my wish for the Merdekas is that they're able to put their heads above water and live to fight another day. If their pay cuts if they have pay cuts, that they get restored fairly soon. If they are out of a job, that they can find something else fairly soon as well. So I think these are the. It's a bit of a somber Merdeka Day wish, but I think it's the reality that times are not easy now.
Yeah, for the times that we're in, definitely.
So Malek, what is the one big audacious habit or goal that you want our audience to take action right now?
I just want one small one. if you've done your cash flow positive, if you're cash flow positive, if done your protect yourself already. I the small goal is just take that first step towards investment. To me, after you've done step one, step two, take that first step of investment. It can be. I think a lot of people fear investment, and they're a bit like, the fear creates inaction, paralysis. And I think to me that small step might, sort of, even if it's just, and these days you can put 100 ringgit, right, towards an investment. There are robo advisors out there that you can just put 100 ringgit and just taste what an investment is like, right? So that's my little goal. I did that for my kids. I took money out of their savings account in Singapore, and I asked permission from them. Can I take a savings account? They said, why, Dad? Because I want you to try out an investment. What about the current? Why can't we just leave it in the bank? You know how much the bank gave you over the last 3 years? $3. The rates in Singapore is ridiculous, right? It's like, I think we calculated it's like 0.6% or something like that, right? Something ridiculous. In fact, 0.06% for one of them. So why don't we just put this into things? Take that small step. So I took that small step for them because they can't do it themselves. They're underage. My daughter did it though. She's 18, so she could do it. And that's my little goal for them. And that's just and for the first couple of months, it was quite interesting conversation. My daughter the conversation still continues, which is great. She's 18. She's very interested. For one of my sons, it's like, what, whatever, And for another son, it's like up and down. Right? Oh, how is it going today, Dad? Okay, and then a month later, no news. And then, how is it going again, Dad? That's okay. So varying aspects of financial kind of like interest. But my daughter, wow, Dad, I did this, and yeah. So she was the one that got me to invest in Beyond Meat, which is this sort of meat substitute, right? So she said, Dad, I want to invest in. If I had a choice, I want to invest in Impossible. Search up Impossible. What's Impossible? Impossible Burger, Impossible Meat. Check. Oh, still private company. Oh, but there's another one that's just listed. They're the competitor to Impossible. Would you like to try that one? And she did. And right now, I think it's up by 70%. So I'm like, that is unusual. To my daughter, that's unusual. You don't get 70% in 6 months just like that, right? But she managed to get 70% in 6 months.
I hear it tastes really good though, so definitely that's positive.
Yeah, exactly. She's a believer, right? So I'm like, okay, yeah. So you can even learn from your kids. What are the trending consumer behaviors that they have, right? So that so I think consuming non-meat is a big theme.
Yeah. I think there was a research done a number of years back where they asked really young kids about what stocks to buy, and they just listed the things that they loved and used, and the choices did fantastically actually.
Yeah. I mean, until COVID happened, Disney was a great one, and I think they're just recovering. But I think Disney Plus, the fact that Disney Plus is coming onto your screen, I'm like, whoa! You got Stars, you got Marvel, you got Lucas, you got the all the different properties, and like and Netflix borrows billions to create these things, and Disney just has them. Like, wow, no brainer, right? So yeah, so that was supposed to be my sort of 10th year anniversary for working for my for my office manager. Basically, it's like we gave a gift of 5 or the equivalent of 10 Disney shares, and so on. And the money is supposed to be used to buy shares in Disney. So I thought she did, but she told me later that it got diverted somewhere else. I'm like,
well, we have a question from Yiwei. So Yiwei is asking, what are the platforms you're using to invest in overseas equities?
Yeah, so I'm actually based in Singapore, so it's a bit harder if you are based out of Malaysia. But in Singapore, there is a company called Phillip Capital that I use. So I use the platform. I think the fees are probably about sort of around roughly about 26 for US stocks, probably about 25 US per trade, which is actually expensive. You can get cheaper. There are other things like in Malaysia, I know you can use Maybank, and I know you can use CIMB to purchase overseas stocks. Maybe you have to check the pricing a little bit. I think a lot of BFM employees complain though that the interface is not so. The buying it is a lot harder. The only thing about stopping me from going for some of these international brokers, like there's something called interactive brokers that you can do. It's just that I don't have. So you put money to them and they're based in the US or wherever, and I don't know if say for example something goes wrong, I'm not sure how to retrieve the money back. Right, they're not regulated by local by our Bank Negara who will come hard, or Securities Commission that will come hard on them. Right? So I need a little bit of that regulatory thing where if you park money with them, that that it's been put into a trust fund. The regulators ensure that they're put into client trust funds and not their own, mixing with their own funds, right? So I don't get that comfort from the interactive brokers of the world. Maybe they do. So I used to also I used E-Trade before at one point in time. That had a bit more of trust for me, even though it's the same as interactive brokers really. But they kicked me out. They kicked me off. They said, "Well, we cannot do overseas clients anymore from me." They're like, "Okay, fine, whatever." So you have to do your KYC. I guess maybe my name sounds like a terrorist name or something.
Thank you, Malek. I guess that's the end of our session.
That's it. All right.
Sorry.
Thank you for having me. Appreciate it. I hope that was a little bit of a color into what I do.
Yeah, that's definitely a lot of things that we have all learned from you today, I believe. And thanks for all the honors and all your own personal stories and sharing. That's very interesting, actually.
Thank you, Catherine. Thanks, Steve. Appreciate it. Thank you very much.
Thank you. Hi, everyone. I really enjoy learning from Malek. I hope you guys have learned a lot from him as well. But if I were to summarize things that I've learned from him, the top 3 tips that he shared with us are really, really useful. Those are the fundamentals that we kind of forget, which are, make sure you have positive cash flow first. And then you look into like wealth protection, which is very important as well. And then it's then you can talk about investment, which are these steps that some people just messed up, or they neglected some of these points. Right? So thank you, PodCat, for listening. You can find the show notes and link our website as usual, mypf.my/PodCat. And don't forget to subscribe and share if you find it useful. And I'll see you next week. Hasta pronto.